Welcome back to the Beat the Odds of Business and Wealth podcast, Trevor. We have something kind of important to talk about today. I think it is not being given almost any attention here in Canada.
Yeah, of course not. There's too many other distractions.
And I think it's a foundational change of the entire banking system, and people think it's something else. So what we're talking about today is we're going to talk about the Clarity Act. We're going to talk about the Clarity Act because I think Canadians most Canadians think that this doesn't affect them at all. Mm-hmm. Even in the U.S., I think they think that this is some sort of Trump thing or some sort of crypto thing. They don't really understand that this is a foundational change to the banking system, and it's going to happen one way or the other.
Yeah, and the way that our banking system currently is with our fiat currency and central banks and money printing and all of that, it all ties in together with that, just using a different medium. So maybe you can talk a little bit about the Genius Act as well, because I know that the Clarity Act is tied in with the Genius Act as well, just providing more clarity on those things. Yeah. Or what direction did you want to take?
I'll give some people some clarity on it, like what exactly is the issue here, and then how it relates to the entire banking industry and how it actually relates to Canada specifically. And I'll give some examples of how this is already affecting Canadian banking and investing for Canadians.
All right, let's get into it.
So what's at root of the entire issue is the crypto industry and the banking industry have agreed that they, previously with the Genius Act, that they have agreed that the stable coins, and so these are coins that are pegged to the US dollar, will not generate any interest directly for the holders.
Yeah, no yield.
Yeah, so there's no yield directly for the holders. Okay, so what that means is these stable coins have to be backed by primarily U.S. Treasuries. Okay, so we're talking U.S. government bonds. Okay, on a one-to-one basis, basically. Okay, so the way the issuer of the coin makes money is they essentially collect the deposit from the person who wants the stable coin, and then they go and they buy a U.S. Treasury, and that U.S. Treasury pays an interest, and the issuer of the coin gets to keep that interest as their profit. Okay. And so that's and the holder of the coin gets something that's more portable, easier to send around, easier to, if they want to send it cross borders, if they want to, use it to interact with other cryptocurrencies they can, but even just transacting in regular fiat currency, it kind of removes some of the barriers.
What it sounds like to me, correct me if I'm wrong, it sounds like a stable coin in that scenario is essentially just a digital dollar. So instead of having a physical one of these or your debit card,
yes,
you're just exchanging in technically USD.
Yes.
And you can't really do much with it other than transact. You can't invest with it. You can't do anything else with it. Is that right?
I mean, as issued, right? But here is the workaround that the exchanges have come up with. So they cannot, be the issuers themselves. They can't issue a yield to the customers. But the exchanges, what they do is they say, put your USDC on our exchange. Okay, put your USDC on our exchange. And then they offer a staking reward. Okay, so they offer a reward to the people who put their USDC on the exchange. Okay, now they're not the issuer directly. So I'm going to look at Coinbase here. Coinbase right now is going to, and this is the Canadian website too. So like this is the .ca version. They're going to offer you 3.35% to put your USDC on their, on their platform. Okay, now how are they making money? So USDC is that's not a coin that's issued by Coinbase. That's a coin that's issued by Circle. So Circle has gone out and issued that coin, backed it on a one-to-one basis with pretty much U.S. dollars, U.S. Treasuries, and a couple of other interest-bearing components. Okay, they're making money because they get to keep that interest. But the workaround in the background is these companies are transacting with each other. And so the Coinbase will basically charge a fee to, or Circle will pay a fee to Coinbase. You call it a marketing fee, call it a promotional fee, saying if you attract, if you attract $10 million on your platform, we'll pay you a fee of X. How is Coinbase doing it? They're doing it from the how is Circle earning the money? From the interest on the Treasury. So they're not paying it to the holders directly. They're paying it indirectly to the platform, who then passes out some of that to the holder. Okay? And that's essentially the workaround that the banks are unhappy with. They're saying we couldn't issue, the agreement is that we couldn't issue a yield to the holders directly, but they're basically indirectly getting a yield.
Okay, so let's say I had this stablecoin listed on exchange. Am I getting any yield, or is it strictly just the people offering it? Because to me, it doesn't sound like there's any benefit to me holding this stable coin at all.
You would actually get that 3.35%. Okay. So instead of holding US dollars in a bank account, or even Canadian dollars in a bank account, getting 0% into your bank, it's like you have this US dollar stable coin that's on an exchange, a publicly traded exchange like Coinbase, who's audited. And the issuer of the coin, it's not like some, Luna coin that's, algorithmically protected. It's backed on a one-to-one basis by U.S. Treasuries, again, issued by a audited company. Okay. So you're effectively getting a pretty low, nothing's zero risk, but you're getting a pretty low risk rate of return. And some people would argue that the risk profile here is actually lower than a small regional bank. Because it's effectively backed on a one-to-one basis by U.S. Treasuries by big companies, okay, big audited publicly traded companies. Okay.
So from what I read earlier and what we're talking about here, it's the banks are afraid of people basically doing a run on the banks and getting out of the U.S. dollar, like with USD, and into this stable coin, because they're getting a yield, they're getting a better return just by holding the currency.
Exactly. Yeah. And people are thinking, because of what's happened in the past with crypto, people are conflating this with other instruments that weren't backed on a one-to-one basis. They were backed on some algorithmic basis, or, they're thinking USDC is the same as Dogecoin or something like that. It's an entirely different instrument. If this was just Dogecoin, the U.S. banking industry wouldn't care. They would just make fun of it and tell you to put it on here. The reason why they're fighting this is much bigger than Donald Trump. This is the U.S. banking system versus a new technology. This is what this is. This will be around long after any administration is here.
Oh yeah, I mean, Donald Trump, he's got 3 years left, 3.5 years ish. No, 3 years, basically 3 years, and he's out, he's gone. So anybody who is making this about Trump or Trump's administration, this goes, like you said, far beyond this administration and the next.
Yes.
And the next after that. Okay. Are we going to get to the point where how this affects Canada, or you still got some more runway on?
There's still some more, because I'll get the ones where, like, this is capital flight from the entire banking system. Like, this is deposit flight, not just from U.S. banks. This is deposit flight from Canadian banks and virtually every bank around the world. Okay. Because they've enjoyed taking large deposits and giving next to nothing on interest for decades now. Okay. So it's structurally going to change the entire banking system. And, the U.S. government it's not just as simple as side with the banks or side with the, side with the crypto exchanges. There's a lot more going on here of why they need these coins. So some people would say, like, well, they don't need it. Cancel it. Just get rid of USDC. Let's side with the banks, right? Or, let's just side with the crypto exchanges, and as if that won't have any change on the way banks take deposits and make loans in the future. It's like we're going to have a shift here one way or the other, right? But I want to show people like why these coins, which people think are just like they're conflating these stable coins with some sort of meme coin or something like that. This is wildly different. This is at the heart of the financial system. Okay, so we talk a lot about the U.S. national debt. Okay, the head of the beast, $38 trillion. We're gonna have a $39 trillion debt at some point, right?
Soon.
And so every time the U.S. government overspends, $1.7 trillion every year, they have to find someone to take on that debt. Either an institution or an individual investor. They have to find someone to borrow from. The Treasury issues the bonds, and if no one buys them, the central bank has to buy. The Federal Reserve steps in and is the lender of last resort. Okay, so what that happens is that essentially increases the size of the money supply. And so we're looking at the last 10 years of the U.S. money supply. Even after basically this 3 years here is the last 3 years is, some of the tightest monetary policy we've had in a very long time. Okay. Basically in the last 3 years, it's gone nowhere. Okay. But even without that, in 10 years, they've gone from 12 trillion to 22 trillion. Okay. And so that is a 6% growth rate, even after putting the brakes on as hard as humanly possible for 3 years. That's all they got it down was a 3% growth rate. Okay. And I'll compare that to, I think I might have the population here. So compare that to the population. The population has grown from, 323 million to 344 million in 10 years. It might look a little more, a little larger on this graph here, but just think about it, 323 to 344, 20 over the 34, divided by the 344. It's less than 1% per year. Yeah. This is less than 1% per year. And so this is gets the heart of the real inflation, not the government CPI numbers. I mean the real inflation, the real purchasing value of your dollar, okay? And when you have the currency expanding at a rate of 6% a year, and the population's only growing at 1% a year, there, I just, we can calculate inflation different ways. Sometimes you look at it and relate it back to the, gold, but basically you have a currency expanding at 6%, population's only 1%. Inflation is at least 5, people. It's at least 5, and it's been 5 for a decade. That's smoothing it out, right? This is not Putin's price hike. This is just overspending and expanding the currency supply, right? This is what the number is. Okay?
Yeah, so we're getting closer to 20 billion Zimbabwe dollars. Getting closer and closer.
So they need to find borrowers for this, okay, because they're not balancing it. So the supply of U.S. treasuries available is increasing and increasing. And what they don't want to do is put the whole thing on the Federal Reserve balance sheet and start a debt spiral, basically. That's not what they're trying to do, okay? So, these are the instruments that people end up buying. These are the short-term 3-month Treasury bills, okay? So the 3-month bills, we're looking at, in the last 10 years, people have been making somewhere between, let's call it 0.25%, and maybe for a moment in time, you would have got 5%. So you just look at that mean here where maybe you're getting 2.5%, okay? Keep in mind, you're holding something that's decreasing in real purchasing terms by 5%. It's decreasing by 5%. They're giving you 2.5%. Okay. What if I go out on the longer term here and I look at the U.S. 10-year Treasury yield? Okay. So now you see where, this thing didn't get to 5. I think that's a hard red line. I think the market is looking for 5%. That's an Armageddon type event. That's a stock market crash event, right? You see it just top out there at 4.8, and there was a lot of intervention and announcements that happened around that point. So we're looking at this, that, we're talking that, this also 3%. Maybe right now today they're getting 4%, but how long will that last? Okay, even if it is 4%, it still doesn't fix the problem. It still doesn't fix the problem where if I'm a sophisticated investor, a long-term investor, that I have an item that's growing by, in real terms, like real population adjusted terms, by 5%. So it's growing by 6%, but let's say if I can normalize for the real productivity for individuals that it's 5%, I'm still only getting 4%. Best case scenario, I'm eroding my capital over time. Okay. And this isn't like me being a contrarian or me being, a conspiracy theorist. It's like, you can see this by the activity of central banks around the world. Okay. Where they have been, you hear this term de-dollarizing. And what does that mean? Okay. So somewhere in and around, 1994, central banks around the world started to pivot off of gold. Okay, they started adopting U.S. Treasuries as their primary reserve asset. Okay, and that trend has basically been the same for the last 30 years until now. Where we have central banks around the world. This is not me. This is not me or my clients buying 1 ounce gold coins for $7,000 Canadian these days, right? But this is central banks buying tons of gold because they don't want to get inflated away. They don't want their purchasing power to be eroded over time. Okay, so we have this. At this point in time in 2025, central banks around the world have basically said that we think gold is more important than U.S. Treasuries.
Isn't that something?
Not the Bank of Canada.
No, of course not. Right?
On an aggregate across the world, what I'm saying is not, it might sound contrarian here, but across the world, it would be the consensus view that gold is more important of a reserve asset than the U.S. dollar because the U.S. has no functional way to get this spending in line. So all they're going to continue to do is expand the monetary base and inflate their debt obligations away. So the best math that you can assemble is, they increase the money supply by 6%, the population grows up by 1%, the real purchasing, I would need a return of 5%. And in order to stay whole, not even to increase anything.
Just to break even.
Yeah. And I'm going to get 4. This is a loser long term. I need to rotate my capital out of here strategically, slowly, consistently over time. And that's what's been happening, right? That's what's been happening. And that's where I tell people, like, a 4% rate of return on fixed income products, a 3% rate of return doesn't make sense. You were just eroding capital, you were just eroding your purchasing power over time. The banks will gladly sell it to you, but sophisticated central banks around the world realize that that's not a good allocation of capital. Okay. The banks will sell it to you. And sometimes psychologically, people want to accept the number going up slowly is actually increasing, but it's decreasing their purchasing power.
Well, it's because inflation is so nefarious. And you don't see it. Like, they tell you the number. They come out and say, our inflation is, 2 points or 3 points or whatever. But in reality, we don't actually see it. It's not like something that hits us in the face like a direct tax.
That's right.
Right? It comes out in the form of, what you're purchasing at the grocery store, going out for dinner, or fuel prices, or things like this. So it happens so slowly and so behind the scenes that people don't recognize it. But regardless, you are losing the purchasing power anyway. So like you said, individuals, if they're in a bank fund or something like that, some kind of mutual fund, they're not going to notice that. But they will see it in their statements because it'll show that, it went up this much, it went down this much, and basically they're about the same as they were the year before. So they're not really gaining anything once you take out all the fees and management and all that stuff. So getting gold. So this is on a massive scale. A country is way different than an individual, right? So they're buying tons and tons of gold. What happens when that supply runs out? I mean, there's a finite supply of gold.
The price goes up, right? I mean, gold does increase, historically about 1% supply every year. which is 1 to 2% actually every year, which is strangely enough the desired target for inflation. That's the uncomfortable part for people who say we're not on a gold standard. Like they pick this arbitrary 2% number based on the expansion of the gold supply historically over time, which is interesting. So we know sophisticated holders are actually selling U.S. Treasuries. So they're actually reducing their exposure to U.S. Treasuries over time and buying gold. So that's a problem for the U.S. because they don't want to balance the budget. Okay, so they don't want to balance the budget. So who's buying it? That's the question. Who is buying it?
Who's
right?
buying what? Treasuries?
Who's buying the Treasuries?
Good question.
So now we get into these stablecoin issuers. Okay, Tether is the largest stablecoin issuer. So Tether was, I believe it was originally founded in, originally headquartered in Hong Kong, and now it's moved to El Salvador. Okay, which is kind of important. This is a trend where people start to realize, and so they have backed their, because they're not in the U.S., they can kind of choose what they back their stablecoin with. It's still primarily U.S. Treasury. So you start to look at this allocation. It seems like actually a pretty smart allocation. It's audited by BDO, and they have 76% in cash and cash equivalents and other short-term deposits. So that is effectively mostly 83% of that 76% is U.S. Treasuries. The other part is overnight reverse repurchase agreements and term reverse repurchase agreements. Okay, you can also see that they're actually 9% in precious metals and 4% in Bitcoin. It's actually a very interesting mix that they pick. And if this is the risk is is this true? They're based in El Salvador. That is that's a legitimate risk factor. But I think it's at this point the history says something. The fact that it's audited by a big accounting firm says something. Okay, and that is a reasonable allocation for stablecoin, and that's why it's the biggest one. And you can see a lot of people around the world might not. They might actually prefer Tether that's not headquartered in the U.S.
Right.
Because they're worried about the sanctions being harsher in the U.S. Okay, and so. This is big money, people. This is I want to look at this number on the screen here. This is 192 billion with a B. Okay, 192 billion dollars. Okay, and to put that in perspective. Let's look at the other one first, and then I'll put it in perspective for people. The other one is the number 2 largest stablecoin on the planet is USDC, okay, which is Circle, and Circle has about $70 billion in circulation, and Circle is, I don't know, see if I can find it here, but essentially, it's actually just right there. So they have 3-month treasuries here. They have overnight reverse treasury repo. So they got aligned directly with the Federal Reserve.
Yeah.
This is how ingrained this stuff is, directly with the Federal Reserve. Okay. And these are the purchasers. So I want to put in perspective here. This is $270 billion backed primarily by U.S. Treasuries. $270 billion. To put that in perspective, I heard some people saying, Carney could just sell the U.S. FX reserves to hurt the U.S. Okay, these are we pulled this a couple times now. Canada has $68 billion of U.S. reserves. Tether has more.
Wild.
Tether has more than Canada. Right? Tether has probably double the U.S. Treasury bills than Canada does.
What I find so funny is all the posturing out there by pundits on the CBC and MPs in Ottawa and other places, just posturing how strong Canada is and how we become our own best customer. It's like, man, you're completely lying to yourself and to the Canadian public as to how gigantic the U.S. market really is and how insignificant the Canadian market is.
Yeah, you start to get where Tether, for example, is top 10 If you look at Tether as a country, the U.S. for FX reserves would be top 10, I believe number 5 even, right? So you're talking like it's bigger than Germany, bigger than Saudi Arabia, right? And it's just growing massively. And so people will say like, okay, you should, you could just shut this down. I was like, okay,
and implode your currency.
Exactly. Exactly. Right. And so if you shut it down, they have no use for, like, that means people would redeem their stable coins. They have to make those individuals whole. And in order to make them whole, they have to sell off the US bonds that they've acquired. Mm-hmm. And so this is not as simple as they could just side with the banks and get rid of these stable coins. This is not Trump coin. This is not Dogecoin. This is the U.S. Treasury market at this point. This is hundreds of billions of dollars of U.S. Treasuries.
So you could liken this to essentially it's a cryptocurrency completely backed by the U.S. dollar. So it's almost, I don't want to say it, almost CBDC, almost-ish. Not quite, but it sounds like that. So it's basically U.S. dollars in the form of a digital stable coin on a network.
That's right. And they need demand. The U.S. needs demand because foreign investors are getting off the train. They're getting off of this. It's too slow, right? So they're pivoting. They're getting away from U.S. treasuries, but people around the world still want U.S. dollars. But a lot of people around the world can't get access to U.S. dollars, right? Even a lot of people in tier 1 countries would rather use a stable coin because they can transact across borders better, or simply they can just get a better rate of return.
Right.
So that's why they're holding this stuff.
Think about somebody, let's say, in Philippines. They could buy this, could they not?
Yeah. So someone from the Philippines who wants to hold basically US dollars instead of holding Philippine pesos, or someone here in Canada who just doesn't want to leave $100,000 sitting at RBC getting 0%.
Right.
Like the interests are aligned here, right? And so the US government needs stable coins because they're running out of people to sell treasuries to. And this is now their main buyer. It's been the growth buyer for years at this point, right?
Yeah. So as countries are de-dollaring and other banks are de-dollaring, they have to have another purchaser in order to maintain their balance so that it doesn't implode and go upside down. Mm-hmm. Is that what we're saying here?
That's right.
Okay, so it sounds pretty precarious.
This pivot is happening out of the banking system, right? Like here's one of the largest, like you see, Wealthsimple, a fintech. They're not, a charter bank, okay? But now they're pivoting cash out of the banking system. They're giving people 2.25%. Okay, they're giving people 2.25%, and that's encouraging capital to come out of the RBC accounts at 0%. Okay, now I want to caution people about, they think that they can overregulate this, that they think that they can overregulate this, that they think they could shut these things down, keep it in the banks, but basically people have now decided that sophisticated investors are waking up. More and more people are catching on. It's like, leaving cash in a bank at 0% interest, or even buying a bond at 3 or 4% is an erosion of capital. Like it's an erosion of purchasing power. Conspiratorial to the retail investor, to the astute investor, they're catching up, and central banks have been catching up have been executing on that thesis for the last decade at this point. And so this is where you see the growth of these platforms. Now, what happens when you try to regulate these companies, right? Remember, Binance actually used to be, it was founded in Canada. People forget that, and it fled, right? Here's another Canadian example, okay? This company here is called Ledn, okay? They have they were originally founded in Toronto. So this was a Toronto-based company, and they try to regulate them. And so where do they go? They're in the Cayman Islands now.
There you go.
This was a legitimate business,
Yeah.
right? And you can see that this capital is flowing. Let me walk you through their business model, right? So Ledn, I've seen clients use it. They offer Bitcoin back loans. So if you want to borrow against Bitcoin, you don't want to get out of your position. I'm not saying you should do this, but I'm just explaining the business model. Okay. If you want to get out of your position, or if you want to get some liquidity and not trigger a taxable gain, a lot of people will borrow against it. Okay. If they've been a long time holder. And effectively, they're borrowing at 9.9%. They got an admin fee at 2%. So let's say it's in the year one, it's 12%, and moving forward, it's 10%. Okay. That's how they're issuing their loans. It's actually an astute business model. When you look through it, it's very simple to understand. I tell people, like, if you can't understand it, maybe there's a problem of why you can't understand it, and especially if they're not trying to explain how it works, right? How do they do that? Well, if you want to lock up some USDC or USDT, so the Circle coin or the USDT coin, they're going to give you 8% on their money. Okay? So think about this. Instead of depositing at the Royal Bank at 0%, Ledn wants to give you 8%. And they have a simple business model. They lend out unsecured Bitcoin loans at 10 to 12%. Okay, very simple, like 50% loan to value. So if you want to borrow against $100,000 worth of Bitcoin, they'll lend you $50,000. And if you get down to 70% loan to value, they'll send you a margin call. If they get to 75% loan to value, they'll give you another margin call. At 80%, they'll auto liquidate you. So at this point, which is a simple business model, which theoretically, outside of any nefarious behavior, could exist in perpetuity. It's a sound business model. Every business model has risk, but big banks have risk.
Yeah. Oh, for sure.
This is pretty simple. They're giving secured loans, not 95% loan to value like most people when they buy their first house. Like, they're giving 50% loan to value on an illiquid asset. They're giving 50% loan to value on a highly liquid asset, the most liquid asset in the world, 24/7. And so, and they're simply just raising capital at 8% and lending it out at 10 to 12% on a liquid secured loan. Pretty simple business model, right?
Yeah.
But that was too complicated for the Canadian government, so they had to go and operate from the Cayman Islands.
I think the problem with the Canadian government, is they couldn't find a way to extract their tax from it. They couldn't find a way to extract something out of it and take a little bit more from the Canadian investor. That's my suspicion.
I would say, there's always a bunch of that, right? But I would say, there's a likelihood that they got regulated out of Canada. I don't know. I'm speculating, right? But do you think RBC wants these guys based in Toronto with legitimacy?
No, they do not.
They do not, right? They want the regulatory stranglehold. And this is the Canadian example, but it's the global example, okay? So what if the U.S. government tells companies like Coinbase, it's like, you can't give staking rewards? The genie's out of the bottle, people. The investor, the astute investor, is going to go looking for that yield around the world. So the only question is this money going to be sitting on local exchanges, or is it going to be sitting on overseas exchanges? The U.S. government's backed into a corner. They're not going to pull the plug on Tether because they're going to blow up their bond market.
Yeah, they can't. They're kind of between a rock and a hard place.
That's it. So the fork in the road here is they're going to come to some sort of agreement and let this activity happen onshore. And hopefully there's a win-win there, because the banks want that stranglehold on 0% deposits, but that's gone, people. Like the only question is how quickly that happens, right?
Oh, well, there'll be a certain population that will not trust this.
They won't.
So they will never ever
It'll
put they'll never trade their greenbacks for this stable coin.
Yes.
Right.
And so they can attack it by that regulation and force these guys offshore, in which case it happens slower. Okay, that's the choice, right? So, or they give it, clarity and keep it onshore, and it will happen quicker. It's going to happen. It's just the speed that it's going to happen, because the genie's out of the bottle. People want to use this, right? It's like, whenever they try to ban something online and people are just using VPNs and they just start using it anyways.
Right.
Like there's someone there in North Korea right now watching YouTube videos on their cell phone. Like that's just how this stuff operates, right?
I have a question. So let's say, because, banks, they can lend out 9 times what they hold on their deposits, right? Mm-hmm. So with this in mind, say, a lot of the capital leaves the banks in order for a better yield with a stable coin. How does that affect the fractional lending? How does that affect that?
That's the point. That's the argument that the banks are making, is they're saying it's going to impair our ability to issue mortgages and small business loans, right? Now, as if all of that, give us your deposits and we'll give you 0% and earn 4 are getting, used to finance in some sort of socialist arrangement. It's like, no, they're pocketing most of it, right? But, and so that will it impair their, yeah, it will. It really will. Are there concessions that they can get? Like maybe the win-win here is the banking gets some better regulations in terms of their reserve requirements so it'll make it easier for them to lend out, knowing that they're going to lose this part of their business, because they're going to lose this part of their business. The question is, does it happen quickly onshore, or does it happen slowly and the capital flees the country? Like that's that's kind of, is it sitting in an El Salvador company, or is it sitting in a U.S. company, right?
Yeah, that's the big deal. And I was thinking, okay, so an option that the banks could have for lending, especially in mortgages, and we discussed this offline, is the mortgage business in the United States. They're used to 25, 30-year mortgages at a fixed rate.
Yeah.
Now, if these rules change and if they adopt this and they need some different, some more, interest coming back at them, they can always switch to a variable rate, shorter terms, kind of like what we have here in Canada. So it helps the banks out a little bit more with that issue.
I think that's actually an evolutionary certainty. That they're going to go to short term, because investors just look at giving long-term loans to the government that continues to inflate away their obligations is a bad risk. So there's more appetite for short duration credit. People are like, I know it's not a great trade long-term, but in the short term I'll take it, but I want to reduce my duration risk. So I think that's and I think a company like Ledn is very small, but it's like it basically gives you an insight into what lending looks like in the future. It gives you an insight into what lending would look like in the future, because it gives you an insight to what lending looked like in the past, right?
Yeah.
Where you had to collect a deposit and then you lent that deposit out. Basically you raise capital at a good rate, a rate that people were really willing to get, that they thought they were getting a real return. You secured it by an asset and you lent it out at a higher rate, and you made that spread. Okay. And you took good security. 50% loan to value, not 5% loan to value, right? That is what lending looked like,
right,
100, 200 years ago, right?
Well, let's talk about Dubai. That's kind of how mortgages work, or when you're buying property in Dubai, you have to have good 40, 50% down, right?
Yeah.
Same idea.
Lots of the world, right?
Yeah.
Lots of the world is like that in terms of the down payment. I think some people look at the Canadian banking system is amazing, and Canadian banking system is good, but I think a lot of people would be surprised about the loan to values, like the starting loan to values in other places in the world, about what they will lend, right? Heck, you go to the Cayman Islands, right? Like they're going to want 40 points down. That's kind of standard stuff in a lot of other jurisdictions, right? Because you just look at how these loans are aggregated, right? And so this is like, the quintessential thing here is the astute investors are waking up, that they're starting to say, like, I do not want 0% interest at a bank. I don't even want 4% interest on a fixed income product. Like this is going to happen, right? The money is going to leave deposit base. It's either going to leave slowly into what people, because they will legitimize it, they'll give it more clarity, right? Or sorry, they'll move quicker if they legitimize it, and they'll stay onshore, or it's going to move slowly offshore. but it's going to drain the deposit system base, right? And so this is going to change the makeup of Canadian banking, like it will, right? It's going to change the makeup of global banking. This is not Trump coin. This is not Dogecoin. This is entirely, the stable coins are largely separate from the rest of cryptocurrencies. Now, they provide a good pipeline in and out of cryptocurrencies, in a quick fashion. You can see that eventually they get backed by, it positions Bitcoin, as you've seen Tether do it. Yeah. They backed it 4% or whatever by Bitcoin. It opens that pipe, but largely stable coins are effectively a way to sell U.S. Treasuries, which is going to happen, right? The motivation is just so high for politicians that that's going to happen. The only question is that, do they side with the banking industry, or do they side with the crypto exchanges, or do they, I would say the most likely is in the medium term, whether it's this administration or the next administration, that they side with both and they give bankers more favorable terms. They give them looser restrictions in exchange for this capital is going to go anyways. We might as well find some sort of win-win here, right? But that's going to change Canadian banks. It's already doing it. It's like, how many people have you talked to now who use a product like Wealthsimple or something else other than a big bank, because
most
they're
of my
getting
customers
a bigger rate of return, right? It's just the motivation for a bigger rate of return. And so I hope that gives you a glimpse into like how significant this is. Now, am I pivoting out of bank stocks? No, I don't think so, because I think long term, the bankers are so ingrained and they have so much influence that they're going to get something back in exchange, right? I actually think blocking the crypto exchanges would actually be a bad deal for both the banks and the crypto exchanges in the long term. Like certainly it's bad for the crypto exchanges in the short term, but it's actually bad for the banks in the long term, because that capital will just go overseas.
It'll go somewhere else.
It'll go somewhere else, right?
Yeah.
So the only question is, do you want to keep it in your home nation state, or do you want to let it go elsewhere, right? And what will Canada do with this? Canada historically has been more agreeable to cryptocurrency. Like we had an ETF long before the US had an ETF, right? Yeah. But you can start to see some things where, like, for example, you can't get a Bitcoin loan on Coinbase as a Canadian. Would Coinbase like to lend to Canadians? Yeah, they make money off it.
For sure.
But regulatory hurdles, right? Regulatory hurdles. So what happens is, you can't do it in Canada. Companies like that set up shop in the Cayman Islands instead. Yeah. Case in point that this is what has happened here. So I hope that's helpful for someone out there, that they start to understand that there are options for you, that capital is going to start to flee conventional banks. It's going to start to flee conventional banks unless there's some sort of like reasonable yield coming back in exchange on the banking platforms. And you start to see it sometimes with the banks, like, we'll give you 4%, and then the fine print is, we'll give you 4% for like 3 months, and then we'll give back down to zero.
Down to 0.
Whenever you see that sign sitting there when you lined up for the tellers, like, how long do I get that?
Ooh, wow, right, high interest.
Right? Or like, I got to sign up for this GIC and I got to lock it in for a year to get 3 points. It's like, you can get that like totally flexible on other means, right? There's ways to get 8 points. You can lend it to Michael Saylor for 11 points right now if you want to, right?
Yeah.
This is, kind of the way it's going to work, but it also gives you a glimpse on credit is going to look different. Credit is going to be tighter. Like loan to values are going to you're going to have lower loan to values. You're going to have higher deposit rates. Like, this is how it's going to materialize, right? And so it gives you some insight into plan. And I tell people, like, maybe the right thing to do is put $100 on a system, put $1,000 on a system, like something like a nominal amount, whatever your financial situation is, and start experimenting with some of these platforms and become financially literate in some of these platforms, at least, right? Test the ability to move in and out of these platforms. Like, what can you do, right? Because they're going to become a bigger part of our lives. Like, maybe they'll come to agreement and RBC will match it. It's like, hopefully when you think about it, it's like how nefarious that is. It's like we're going to regulate the competition of the banks out of existence. Like, how can that be the right choice? I'm not saying that if they pass this act and they give the crypto exchanges more freedom and that there won't be unintended negative consequences. There would be, but my base assumption is just got to be regulating the competition of the banks out of existence is not the good idea. Like, it's not good for the customer in the short term, and in the long term, the capital is going to flee anyways. That's it, right?
Well, and I mean, if you think about it, you can't really, get rid of the banks. You can't, regulate the banks out. But when it comes to these exchanges, they don't have the infrastructure yet to do mortgages or to, do payments for, set up bill payments and these types of things, right? Good for investing, good for storing, and good for moving money around, but not necessarily your everyday banking.
They still can't rehypothecate money. So they got to find a way. They have that chip. They have the fractional reserve chip. Remember, what's the reserve requirement? It's like, well, okay. It doesn't have to be anything. Remember, it's fake, right?
Yeah.
Why do they banks historically have not got the deposit and then lent out the money. They lent out the money and then looked for the reserves after. That's the cycle. Most people don't understand the order of operations there. So there is a requirement out there that probably protects the bank's interest, but also allows this, to operate in some sort of healthy competition that gives the individual more freedom, more options.
Yeah. Awesome. Love it.
I've got a whole bunch of stuff in the chat there.
Okay, here we go. I'm going to go to the top here. So Sean asked, is this why USDT and Circle own so much U.S. bonds? Is this protection against getting sanctioned or shut down?
It's just a sustainable business model. So it's just, they're not in for some short-term, how do I make 40%? They're just saying, let's just collect hundreds of billions of dollars and make 1 or 2%. And so, decent business model. Like it's just a good business model. So they 3 or 4% is a bad rate of return, unless it's someone else's money. I don't want to take my capital invested at 3%, but if I can take someone else's capital and give them nothing and collect 3 or 4%, that's an amazing rate of return, right? Yeah. That's why Tether is one of the most profitable companies per employee on planet Earth, I believe, right? So that's why it really would be, if they're thinking long term, these stablecoin issuers, like, they got to realize there's going to be big dips in weight, and they just need maximum amount of liquidity and the lowest volatility possible. They don't really worry about the low rate of return because it wasn't their capital. That's why.
Right. Okay, next question. Do you believe fintech is the future? Do you see this industry overtaking traditional banks like RBC and TD in market share? Lots of fintech companies would find it challenging to run in Canada.
Yes, I definitely see that there's going to be competition in both the U.S., in Canada, and every tier 1 country that fintechs are going to fill a void. There's still going to be the place for the banks because they're going to have some sort of exclusive use or cachet on payment rails. They're going to have the ability to create currency, which is the fintechs don't have the ability to create currency. They have to have someone else's capital to lend it out. They can't just create. People don't understand that the banks create the capital with a keystroke. They're not just lending out your deposit. They actually create new money with they call it the money multiplier effect. So there's still an existence on, what the fintechs can do that the banks are not good at, and what the banks can do that the fintechs aren't allowed to do. It's still going to be there regardless of this.
Okay. Due to banking regulations, and aggressive protection that the government gives the 6 banks. Yes, that's true. There's lots of regulation and protection of the banks. That's why we invest in them. So next question here. D. Devadius, if you wanted to invest in the crypto chains that the stablecoins run on, would you choose Solana, lower share but cheaper and faster, or Ethereum, highest share but slow and expensive?
Yeah, I don't own any Solana or Ethereum. I've gone through this at the bootcamp, right? I do think there's other winners in the crypto space. I only own Bitcoin. I do think there's going to be other use cases. I just haven't seen a compelling enough use case right now. I really just think, you're looking at hundreds of different of utility coins, but I haven't seen that utility. I'm like, that makes sense. I really just think we're looking at Betamax and VHS, and sometimes streaming is going to come along. Yeah. I've always seen, I just haven't seen the utility yet, whereas Bitcoin makes sense as a digital gold, as a store of value. I get it. When you look at the principles of money, is it portable? Is it divisible? Is it durable? How this works, right? I mean, that's why it's essentially an institutional grade investment, as you're seeing, right?
Right.
That's why you're seeing ETFs from BlackRock on where does it start? It started on Bitcoin. So at this point, I don't have enough comfort on anyone to deploy my capital, or even recommend for any of our clients in the corporate treasuries that we manage for any of the other altcoins.
Okay, let's see here. Which of the 6 big banks do you think will be the first to buy a crypto exchange? That's an interesting question.
That's a good question.
Yeah.
I've never actually considered that before, right? Which would be the first? I don't know. Gun to my head, I'm gonna go with Scotiabank. They kind of they've ventured kind of free and hard into Latin America, so they seem to be a little more forward thinking, a little more risk taking. I have no discernible. I'm just I'm picking the score of tonight's hockey game. But if I got to pick one, that's what I'll go with. But I would not bet on that at all.
Donnie Z9U. The banks are upset with that people would actually yield more than 0.01% in a savings account.
Yeah, they want to lobby the government to make sure you get that 0.1%. It's absurd when we're talking about it, right? The outcome is certain here. The genie is out of the bottle. People are going to stop accepting 0.1% over time. It's just how we do it. Do we do it kind of with clarity onshore, or do a little more quickly and orderly, or are we going to do it offshore slowly? But it's going to happen. That's it.
I mean, the smart money is, you want to make more on the money you have. So here we go, Sean. But could the banks lobby to make it harder to withdraw capital out of their customers' checking savings accounts and into Wealthsimple? Well, they kind of do that already.
They do.
They do that already.
They do. Yeah. I have $88,000 stuck in cyberspace right now. I'm going to transfer to Wealthsimple. So they already do make this really difficult, right? Unnecessarily difficult. That's why cryptocurrencies win, because people are going to see they're just not that portable. Anyone who's operated businesses or overseas starts to realize how bad this is. It is there already is de facto capital controls on moving capital, right?
So, for sure. Walk into a bank and ask for $10,000. I need $10,000 cash right now. Yeah. Get ready for a talk.
Yeah.
What do you need it for?
Yeah, just transferring anything other than a email or e-transfer or bill payment. You start sending wire transfers or cash over. It's a reportable event.
Yeah.
What is over 10? There's a reportable event that's generated on you in the background, right? Just a wire transfer over 10,000 where they're assessing the risk on that, right? That's a reportable event, right?
Yeah, it's crazy. Okay, so last thing we got here. Financial freedom lifestyle. Great work, you guys. Hey, appreciate it. Thank you. And last one is banks like TD and RBC stocks did so well this past year. Is that still expected to continue in 2026? What's your crystal ball say there, Josh?
I'm not. They're certainly more expensive.
Oh yeah.
They're more expensive. Anyone who's been coming to the boot camp and looking at our treasury list, they've been falling off the treasury list, right? But when they fall off our treasury list, it means we're still holders. We're just not. We're just not deploying new capital into them. Could there be headwinds? We're delving into an uncertain future. So the volatility is going to go up. But does it interrupt my 100-year thesis? If the valuation was right, if the dividend yield is right, would I still deploy capital into a bank? Yes, I would, because I think they're going to have a stranglehold on some things. I just think this, the stranglehold on zero interest deposit is going away one way or the other, right?
Yeah.
But they'll find ways to, they'll still sell some people their 20-year trailer loan.
Yes,
they'll still give them their 20-year trailer loan. They'll still give them their 29% credit card. They're still going to charge the transaction fees. They're still going to be able to issue loans at the end of the day. They're still going to be able to print new money by the stroke of a button and lend it out, right?
Yes.
And so they're and they're going to be able to do all of that by replacing a big degree of their workers with AI.
Oh, absolutely.
A big degree of, so they're going to be able to drive their labor costs way down. Where, I think we think of some of these fintechs as technology companies, but I think people are maybe underestimating that banks might end up functioning like technology companies, right? Because they have the biggest infrastructure, the biggest amount of knowledge, the most amount of capital that can access these technologies, that they're going to do more. They're really going to drive those labor costs down. So this is still a 100-year thesis. I think so. I think banking is still here in 100 years, because it was here years and years before, right? Banks created currency before central banks existed. That's with private bank notes.
They issued their own.
This has happened for hundreds of years. So it's a business model that might change with regulation, but it doesn't go away.
All right, awesome. What do we got here? So next one here, banks TDC. That's right. One more from Sean, and that's it. So we got, will this capital fleeing out of Canada hurt our economy over time? Will it decrease our GDP per capita? How will this affect Canada long term? That sounds like financialization that's talked about. Well,
there's a lot
of questions there.
There's a lot of,
try to keep it to one there, Sean.
Will this capital fleeing out of Canada hurt our economy? I think it does. I think if governments make the wrong choice, they're not going to cut off the printing of money. They have no desire. I mean, they could get rid of stablecoins if they balance the budget, but they don't want to balance the budget, so they got to keep stablecoins because that's the price of admission, right? I think long term it really does put capital in different jurisdictions, and I think that makes for weaker economies. I think it's against the everyone's the people's, the crypto exchanges, that's in against their short-term interests, and I think in the long term it doesn't suit the banks either, because that capital will leave one way or the other. So
okay, and then Ty, buy the dip.
Buy the dip. Yeah, I think I posted. This is not financial advice for anyone, but I view the I don't know your circumstances, of the viewer out there, but I think 88,000 was a real level. That's why I posted on Instagram. That's something that I was looking at for a 50% pullback from the absolute tippy top, right? That might be strange for people, but I think it's kind of fun. We got to keep all these paper Bitcoiners who've only owned paper ETFs. We got to take them on a round trip, just like all of us hard wallet Bitcoiners have been around a time or two, right? So, but I it's funny. It's still going to be, this time is different. It's like, until that budget is balanced, people, it's not different. It's just the same, right? So,
they have to do something. There's no other options.
Quantum FUD, and it's just Satoshi's Epstein, and it's just what else are we gonna come with people? There's one thing happening here, and then the conspiracy theorist to me is like, are these things connected? Trump owns a lot of Bitcoin. Is the banking industry going to try to really put the screws to him, get their short-term bill passed that they want? Right? That's been your mind goes there. So what is people's economic incentive in this? Would they dump that asset as leverage with this negotiation going on? It's like, well, I wouldn't put it past them. I'm not saying that's what happened. I'm just saying that's it's a potential explanation.
And just another thing to put out there. Okay, so let's say Bitcoin absolutely tanks and the cost of mining the Bitcoin is greater than the actual yield of the Bitcoin, actually owning it and mining it. Then what happens to NVIDIA?
Yeah.
What happens to the NVIDIA, right?
The NVIDIA doesn't have a difficulty adjustment like Bitcoin does. So, that's that problem's designed to kind of rectify itself, right? Even with the difficulty adjustment, that reduces the security of the network, but ultimately we're looking at the most secure computer network by a lot, by orders of magnitude already. So not materially going to affect that there. So confident, just as I am in any other asset. And what's the thesis is real estate, dividend paying stocks, gold, or Bitcoin. I'm still way more worried about real estate than I am about Bitcoin at this point.
Awesome. Yep. Well, thanks so much, guys, for joining us on the podcast. Don't forget to like, subscribe, share with a friend, and see you at the next boot camp. See ya.